Interest rates are rising, stock market's falling. Where is the market headed and where is the smart money going? Hi, my name is Kareem Zakir and welcome to my quarterly capsule. Before I answer those questions, I'd like to welcome two new members who have joined our team. The first being Steve Goulet, who's a graduate of McGill University and a chartered financial analyst. He will be helping me in portfolio management, individual stock analysis, and asset allocation strategies. And Orith Sampson, who's also a McGill graduate, who's worked in the financial industry for over 15 years and will be assisting Kendra and Lillian with the day-to-day administration in addition to trading. Also, I'd like just to touch base a little bit about our offices. They're currently still closed due to the Omicron variant. We're all working remotely, but we hope to go back by the spring. And please don't forget, RSP contribution deadline is March 1st of this year. That's to get a deduction in 2021. The amount is $27,830 or 18% of your 2020 taxable income, the lesser of the two. The 2022 RSP contribution is going up to $29,210 and or 18% of your 2021 taxable income. That'll be the lesser of the two. In addition to that, there's the TFSA contribution, which is for 2022, $6,000. And the cumulative amount so far, if you have not contributed to a tax-free savings account, has reached $81,500. I'd also like to touch base in reference to your portfolio performances going back 3 calendar years up until the end of 2021. You'll notice that your portfolios have done anywhere from 25% cumulative returns over those 3 years, all the way up to 40% for a more aggressive growth type portfolio. So if you were conservative, you averaged about 25 to 27%. 3 years combined. If you were growth, you had anywhere from 35 to 40% return over those 3 years. Now we've started 2022 on a tougher note. For instance, the markets have dropped quite significantly just in the month of January alone, whereas the NASDAQ is down about 12% up until the end of January 29th from January 1st. The S&P is down a little over 7%. And the TSX composite is down approximately 2.25%. The reason the TSX is doing better than the S&P 500 and the NASDAQ is because a large portion of the TSX 300 is made up of energy stocks. And so energy has been quite strong in the last month or so. Your portfolios are not down nearly that much as the markets are because you're diversified. Nevertheless, you will see a drop anywhere between 2 to 4% just in the month of January alone. Now, if you've made 25, 35%, let's say in the last 3 years, and you get a drop of, let's say, 4 or 5% in the month of January, please don't panic. This is normal. It happens all the time. Actually, corrections of about 10% happen on average every 18 months. We're currently going through a correction right now, and it's actually offering a lot of good opportunities for those who have money sitting idle and don't know what to do with it. So the time to buy is when it's going down. This offers another great entry point so that we can prepare for the next leg up. So this brings us to 2022. Where are the markets headed? Well, before I talk about the stock market, I'm going to mention the bond market. Not too many people are aware of the bond market. The bond market is a lot larger than the stock market. And right now, the bond market has priced in 4 consecutive quarter point increases starting March of 2022. Now, you haven't seen it at the bank level yet, but it's going to follow through to the bank level. But the bonds have already reacted and they're pricing in 4 quarter point increases. If we get 5 or 6 quarter point increases instead of the 4 that's already priced into the bond market, expect the stock market to react negatively. If for whatever reason interest rates only go up 2 or 3 times in the next year, then you're going to see the stock market rally. My take in reference to the stock market is that we're probably going to have a very volatile first 6 months of 2022. The reason being interest rates are rising, so that kind of affects stocks. You've got the midterm US elections coming in November of this year. Expect a lot of criticism to fly between the two parties. That creates uncertainty, it makes people scared, and creates a lot of volatility. And then on top of all that, you've got Russia looking to possibly invade Ukraine. Now, whether they're going to invade Ukraine or not, I don't know. I would assume that because China is allied with Russia, the probability of Russia invading Ukraine won't happen till after the Olympics or even the Paralympics, because China does not want the attention to be diverted from the Olympics. And knowing that China and Russia are allies, odds are Russia will probably listen to China. Now, I can't guarantee this, but based on my geopolitical readings, this is what I see happening, unfolding. It could also be a tactical ploy, a political ploy to try and get something out of the West for Russia. We'll have to see how that plays out. And all this is going to create some volatility in the first half of the year. I see the second half of the year probably doing much better. You probably see markets stabilize and start to rise because we're going to have more certainty by then. Of course, we'll know where Russia and Ukraine stand. We'll have a better idea of where interest rates are headed, if they're going higher or lower, or if we're going to start entering into a recession. And lastly, the election in the United States will create certainty one way or another. Be rest assured, I'm watching the situation very carefully. This brings me to, where is the smart money headed? When I say smart money, I'm talking about the pension funds, like the Canada Pension Plan, the Quebec Pension Plan. There's a lot of other pension plans around the world, in addition to hedge funds. Where are they positioning their portfolios? Well, from what I see, a lot of them are going towards the long end of the yield curve, meaning they're buying long-term bonds, something I've alluded to in my previous capsule. And they're getting out of the short-term bonds. So that means that the short-term rates are rising and the long-term rates are either stabilizing or actually going to be going down. This is inverting the yield curve, which means that a recession may unfold in the next 12 to 24 months. Now, it doesn't mean the market's going to crash. The market is already seeing this unfold. So you have to be invested in the proper sectors. And currently the sectors that are doing well are the energy sector, the utility sector, the industrial sector. Sectors that are quite defensive are outperforming growth sectors like the technology sector, which is really what we saw fall quite dramatically in the month of January. Now, I don't believe that the energy sector offers secular growth because of the transition to renewable energy. I see actually this is a temporary blip for the energy sector, and I would remain invested in the secular growth sectors such as the technology sector, the healthcare sectors, so on and so forth. So this brings me now to a study that Fidelity has done, where they've proven that dealing with a financial advisor, dealing with a team, increases your wealth by 2.3 times versus someone that wants to play the game on their own. And the major factor here is emotions, sentiment versus study, strategy, and fundamentals. So for all those DIYers who keep trying to win the lottery, I suggest you consult a financial advisor, a team that's well seasoned, that can help you actually increase your wealth through a proper plan. And lastly, I'd like to conclude by letting you know that we are still doing our meetings online, face-to-face. In addition to that, I just want to remind you that if you need a financial plan, a retirement plan, a portfolio strategy plan, please reach out to us. We're all here to help you and to help you improve your wealth. Thank you, and I'll speak to you in the next quarter. Bye.